So we're going to take a look at this question called Egin. And we're going to go through it bit by bit. It's all about related parties. And it says discuss why it is important. Explaining the criteria which determine a related party relationship. So I'm going to say, first of all, what are the criteria? And we'd list out the criteria, and this is a straight knowledge dump. This is, what do we know? So the criteria, we would say for entities, parts of the group, associates, joint ventures. And clearly we'd write more than that, but for individuals, control, influence, key management. Notice there's only 5 marks here, so don't write lots, because that's not going to generate extra marks. Always look at the number of marks available and just write 2 lines on each of the main areas. And close family relationships. But the question then says why it is important. So we've been through the criteria, then attempt the second part. Why important? And if you're short of ideas, always go back to the framework for your ideas. Financial statements are supposed to produce useful information for investors and lenders. That's the whole reason why we have sets of accounts. That's the reason why we have accountants. For information to be useful, it must be, and you can go back to the framework, the key criteria that we're looking at must be relevant, and it must have faithful representation. And then it has what we call enhancing, as secondary characteristics. It must be complete. And this is really where related party information comes from. Therefore, we must ensure users are aware of transactions with individuals or entities who are not independent or at arm's length from the business. So can you see I've written 3 points. So again, I'm trying to use my broad rule of trying to get it into 2 to 3 lines, 2 to 2.5 lines. So I think that's enough for part A1, because I'm looking at it all the time and saying, 5 marks, 5 points. I've got at least 5 points there if I've listed out all of those issues. So we therefore move on to part A2. It says describe the nature of any related party relationships and transactions which exist within the Egin Group, including Tang. So let's take a look at the Egin Group. And I would start off by saying that Egin is a related party to Briars and Doyle because it controls both entities. In Egin's group accounts, this should be disclosed. But there will be no disclosures of transactions. Because they are eliminated upon consolidation. Any transactions between the parent and the subsidiaries, or between Briars and Doyle, would be disclosed in the notes or in the books of the subsidiaries. Because these transactions are only eliminated when we prepare group accounts. Next, I'm going to look at Briars and Doyle. These are related parties to each other because they are under the common control of Egin. We then come to the issue of I. I is a related party to Egin because I is an associate. Let's just take a look at, it says the directors of Egin are also directors of Briars and Doyle, but only one director of Egin sits on the management board of I. This is because Egin has more than 20% of the shares and appoints a director. To the board of I. It says in the narrative, and it's really important to read the narrative, there was a fifth company, Tang, which was a 70% subsidiary of Egin, and that was sold on the 31st of January X6. When is our year end? It's the 31st of May X6. So next I would look at Tang. Tang is a related party to Egin, Briars and Doyle because the related party rules relate to companies that were subsidiaries at any point in the year. So here we have a company which was a subsidiary for 8 months of the year. So therefore it's a related party. So again, I'm mentally saying, well, how much have I written? Can you see I've got 4 or 5 sections for 5 marks. I've written enough here for 5 marks. Because you're going to get at least 1 mark for each element that you deal with. So I'd probably say I've now considered myself to have done enough on this. Next we've got Spade and the Egin Group. And what is the nature of the relationship? Spade and Doyle are related parties. Because Spade has significant influence over Doyle. It says that in the question. If you look at the last paragraph, or sorry, the last sentence on page 26, the remaining 40% of the shares in Doyle are owned by Spade, which exerts significant influence over Doyle. Spade, therefore, is a related party to Briars and Doyle. Sorry, that should say, yeah, that is right. Oops, I misread that. Spade is not a related party to Egin because Spade has no influence over Egin it is merely a shareholder. In one of Egin's subsidiaries. It is unlikely that Spade is a related party to Briars or I because it has no influence over those companies. Because Briars is a fellow subsidiary of Doi and I is an associate of Doi's parent company. So there's no direct relationship between Spade and I itself. So it's very important when you've got a related party question to state not only the related party relationships, but those relationships which are not related parties, because there will be marks available in the exam for expressing those comments. Next, we've got atomic in Egin. This is what I misread a little bit earlier. Apologies for that. Atomic and Egin are related parties because Atomic has significant influence over Egin through owning 30% of the shares. Because Atomic can influence Egin, it can possibly influence the entities that Egin controls. So therefore, Briars and Doi are probably related parties to Atomic. I'm now going to take a look at the transactions in the year. And it says we should comment on whether transactions should be described as being at arm's length. And if you take a look at the top of page 27, during the year, Doi has sold a significant amount of plant to Spade, and Spade has significant influence. The directors of Egin have proposed that where related parties are determined at normal selling price, that any disclosures will state that prices charged are at arm's length. Arm's length means that the two parties have independently and willingly traded together. Because Spade owns 40% of Doi, this is not the case. Therefore, in the notes, it should not say the transactions are at arm's length. Instead, it should state they are at normal selling prices. Now, I've got to be honest, ladies and gentlemen, that's a bit of a nerd point. Not many people picked that up in the exam itself when this question was set. So that's part A. We now have part B. It says, describe with suitable calculations how the goodwill arising on the acquisition of Briars should be dealt with in the group financial statements and how the loan to Briars should be treated in the financial statements of Briars. As soon as I see the word "and" in a question, I'm thinking two questions. Let's break this down. So goodwill. And we're dealing with an overseas subsidiary. So when you do goodwill in relation to an overseas subsidiary, I'm going to put some calculations in euros, some calculations in dollars at the acquisition date, and some calculations in dollars at the SFP rate. How do we calculate goodwill? Goodwill is the cost of the investment. How much is the cost of the investment? The cost of the investment is $50 million. To which I'm going to add on the NCI at acquisition. Well, Egin has bought 80% of Briars, so the NCI are going to have 20% of the net assets. We're not given a fair value, so we'd have to assume that the proportionate method is being used. So 20% of 45 million euros is 9 million, less the net assets at acquisition which we know are 45 million euros. That gives us a goodwill figure of 14 million euros. At the date of acquisition, the exchange rate was 2 euros to the dollar, which means that we've got a cost of the investment of 25 million euros. But at the SFP date, the exchange rate is 2.5 euros to the dollar. So we've got a revised cost of the investment of $20 million. So we'd say that in the books of the parent, and who is the parent? It's Egin. We would restate the cost of the investment from $25 million to $20 million at the SFP date. Why are we doing this? Credit investment, $5 million, and we would debit the income statement $5 million, because we're measuring at fair value through profit and loss. There we've got to use the closing rate of exchange. At the SFP date, we've worked out goodwill, and that gives us a goodwill figure of $5.6 million. But it says in the question, it is established that goodwill is impaired by $3 million. So I'm going to impair goodwill by $3 million, which takes us down to an SFP value of 11 million. Everything we put through reserves, I'm going to put through at the closing rate. So that impairment at 2.5 to the dollar gives me an impairment of 1.2 million. So the goodwill figure in the statement of financial position is $4.4 million. Okay, so that's goodwill. We also have the loan. It says in the question that Egin made an interest-free loan to Briars of $10 million. It's to be repaid on the 31st of May 20x7. When did we make the loan? It was at the date of acquisition, which was the 1st of June x5. So the loan is for 2 years. And per IFRS, should be measured at amortized cost. This is because Egin is entitled to cash flows on specific dates and intends to collect. Those cash flows. So when was the loan made? Well, Egin purchased 80% of the share capital of Briars on the 1st of June X5. So what we would do here is on the 1st of June X5, the loan is measured at, how much is that going to be? It's $10 million. The rate of interest is 6%. And that loan's for 2 years. So we've got to show it on an amortized cost basis. Let's work that out. That's 8 point. That's 8.900 million. So I'm going to say here, date 1st of the 6th X5, the dollar value of the loan is 8.9 million. So this is going to be in the books of Egin. Sorry, I got the wrong company there. But we're also going to show the books of the subsidiary Briars. And Briars is preparing its accounts in euros. So what rate are we going to use? Well, it's going to be the rate of the 1st of June X5, and that rate is 2. So that gives us a loan of 17.8 million. So in liabilities of Briars, we've got a liability of 17.8 million, and in the receivables of Egin, we've got a loan of 8.9 million. We've then got the interest received. As far as Egin is concerned, it's 8.9 million at 6%, which is 534. But when it comes to Briars accounts, because it's an income statement item, we're going to use the average rate for the year of 2.3. So I've got 534,000 times 2.3, 1228. At the 31st of May X6, we're going to show our loan, and it's 8,900 plus 534 . It's a figure of 9434. What exchange rate, because as far as Briars is concerned, does Briars owe to Egin 17.8 million euros? How much does Briars thinks it owes to Egin? It owes $9.434 million, doesn't it? What rate of exchange should we use to translate that? 2.5. can you see we've got a problem? Because in Briars' books, we're showing the loan at 19.028, but it should be showing the loan as 23585. We therefore have an exchange loss in the books of Briars, and that exchange loss is the difference between the two figures, 23585, which is 4557. So that exchange loss is debit the income statement and credit the liability. So that's a tough, I thought that was quite a tough question.